next week. They've hinted at what they are, basically not culling herds as aggressively, not culling flocks as aggressively as they've done in the past, and also considering maybe vaccinating fowl, poultry. Those two have downsides, too. If you don't cull the flocks, this spreads very quickly within a flock once it gets in, and it's 100% fatal. So whether you cull the flock or you allow this to spread at some level, you may lose the flocks altogether anyway. And from the standpoint of vaccinating baby chicks, we export a lot of baby chicks in this country to countries like Europe and China, Mexico, Canada, the Philippines, Indonesia. And if we vaccinate them, probably other countries aren't going to accept the export of our baby chicks. And that's one reason why the industry, the poultry industry, has been against mass vaccination, because the vaccine itself isn't sterilizing. So you could still have a situation where a chick becomes infected with the virus and can spread it, but it's asymptomatic, so you may not detect it. So Europeans don't want our chicks if they've been vaccinated because they worry that they could be harboring the virus. So there aren't any easy answers here. From the standpoint of a human risk, I think that hasn't changed. That's out there. There is a risk that this could mutate in a way that could infect humans. And the more virus you have circulating, the more that risk goes up. But I think it's a low probability risk at this point. But I think the more imminent risk is to domestic agriculture.
We'll leave it there. I appreciate your time, your insight, and your valuable clarity, too, as always. Dr. Gottlieb, thank you very much for that.
Thanks a lot.
That's Dr. Scott Gottlieb. Another point of concern for the markets, no doubt, the Fed. Steve Leisman joins us now because, Steve, this is a week in which there was a lot of Fed speak that leaned decidedly hawkish.
Yeah, if you were hoping for rate cuts this year, you might want to have to take a step back and wait a little longer. I think one is still priced in, but I think the change this week, Scott, was you still have this inflation problem. And by the way, those numbers today in the University of Michigan inflation expectations were not helpful to the Fed. You have this inflation problem, but more and more now what's happening, Scott, is Fed officials are taking that inflation issue and putting the issue of fiscal policy uncertainty at the same level. So saying, look, we don't see ourselves cutting rates until, one, we get the inflation problem still heading back towards 2%. By the way, they have confidence that's going to happen. And two, that we ultimately have some clarity on where these fiscal policies are going. Virtually every Fed speaker this week, and there were quite a few, mention it. Some a bit more concerned than others, even like Alberto Musalem talking about negative scenarios that could spin out from the certain fiscal policies that are currently under discussion.
Allude to what was no doubt the more hawkish commentary of the week from the St. Louis Fed president, where he used the words more restrictive. No one's used that commentary when talking about the potential outcomes here. And he said the quiet part out loud.
Yeah, and you always say to yourself, well, you know, it's a theoretical possibility. Is it just a theory? Well, why did he choose to mention it? What you just mentioned, Scott, flowed directly from what I had talked about, which was this notion that you have a possibility of immigration policy and tariff policy raising inflation, and you might get a decline in growth. And in that context, he could envision, again, a theoretical construct here, but in that context, you could talk about possibly being more restrictive. Most Fed officials have put forward this idea that, hey, we think we're restrictive now, we're above the neutral rate, so we think we're well positioned for whatever outcome happens without having to raise rates. Alberto Musalem, as you exactly said, Scott, said the quiet part out loud.
Steve, thanks as always. That's Steve Leisman, our senior economics reporter. Back to the panel. So, Steph, how much are you thinking about the Fed? Nobody had on their bingo card rate hike in 25. Nobody. But they don't know any more than anybody else about the trajectory of inflation policy. Do they?
Well, I would be surprised. I mean, look, they're looking at the PCE. That number next Friday is going to be huge. But the PPI data points that go into the PCE suggest that it's not going to be runaway inflation. It may just be stubborn for a while. It may just be 2.5% PCE, core 2.6%. But I have always argued that if you have higher growth, you are going to, by definition, have a little bit higher inflation. And so we have taken off the outcome of the Fed cutting this year. And I think that's what the market has kind of been telling us for the last couple of weeks.
Well, I feel like the market might be telling you today that we are going to have lower growth than thought.
They're not.
Well, why are yields down today?
I don't think they're going to be because of the growth. That's what I think.
That's what I mean.
Is coming down, but if 2% is still above trend. Trend is 1.5%. 2% growth is probably a mid-single-digit revenue number for earnings. In earnings, and it's probably like mid-single, upper single digits for earnings overall.
I know, but you said that. But you said that this was a pro-growth administration, which many believe that it is.
It is.
There would be no argument on that.
It's not as growthy as what we have been seeing on the fiscal side from the prior administration. I mean, we put in 60% of U.S. GDP in fiscal and monetary policies throughout COVID. We put a ton of money in the system. That is not going to happen this year. But that money that went into the system led to better growth, much better growth, right? 3.5%. Now, if you don't have that, you probably grow something like 2%. That's not dire, and it's certainly not recession. To Cameron's point, it's not. It's just a recalibration.
Okay, recalibration of expectations too? Is that a single-digit return kind of year?
It could be, very much so, just because the best you could get in stocks would be the earnings growth. You don't get the valuation expansion. But we do think that the recalibration part of this cutting cycle for the Fed has been over, simply because there was not enough evidence to suggest that growth was falling off a cliff, that they needed to deliver further cuts, given the fact that even though they say they are restrictive, you have been growing above trend the entire time the neutral rate has been positive. You've had easy financial conditions, which all suggest this wait and hold kind of mentality from the Fed. And we do think there's a very big difference between growth that is slowing and growth that's falling off a cliff that gets the Fed to act in a more aggressive way. We think you'd have to see a mid-4s on the unemployment rate to really see the Fed step in and deliver a lot more rate cuts.
You know, Malcolm, and then we get next week, NVIDIA, you sort of alluded to it, that company's going to report mid-next week. There's always a lot riding on it, as we know. Given what happened with the DeepSeek sell-off, and even though Jensen Huang, the CEO, commented on it, albeit briefly in the last 24 hours or so, this is really going to be our first look under the hood of what they're actually thinking about demand. We know what the hyperscalers are spending, but we're going to get a better look on where the environment currently is.
Yeah, Scott, you said it. DeepSeek changed the game for NVIDIA and for NVIDIA shareholders. And I think that it might have actually done them a little bit of a favor in the sense that it gave them some cloud cover, right? So Jensen had been making comments about the rollout of Blackwell or the shift to Blackwell not exactly going as planned in previous quarters. And I think that maybe there's some of that sentiment, you know, that gets a chance to get out there now under the cover of the DeepSeek news. And more than anything, it at least took away the conversation or the concern that investors had about aggressive valuation on that stock, right? We were talking about something like 40 times this year's earnings 2 quarters ago. And now the shares have sold off. They've recovered some since the DeepSeek announcement, but they haven't quite gotten back to where they were. And I think that might actually be a positive for NVIDIA going into earnings next week instead of hurting it as badly as we probably thought it would 4 weeks ago.
Steph, what do you think?
NVIDIA specifically, I think the expectations are still quite high, and the stock is up 100% in the past year, and everybody owns it, probably except me. But the expectations are high, and I don't know if they're going to raise numbers as aggressively as they did and they have been doing over the past year. I don't think it's going to fall off a cliff. And you mentioned the hyperscalers. The hyperscalers aren't cutting back. They're increasing the numbers, right?
Up.
So that does help them. I just think the expectations are really high. So I think, wouldn't be surprised as the options market is pricing an 8% move either way. I don't think that's a really big deal, considering how much the stock has actually run up. But I would wait, in terms of buying other semiconductors, I would wait until they report.
How big of a moment is this for the market next week as it goes into a new week a bit unsettled?
Yeah, we think it is still a very important moment simply because it has such a large weight in the indices and it encapsulates the hope of all of the AI trade. And looking at the technicals of NVIDIA, it's not all too inspiring in the very short term. If 125 doesn't hold, we do think you could see something closer to 100. That's very normal for NVIDIA to experience that kind of volatility. But that kind of volatility is something that the market has not been used to over the last couple of years since we've been in this very powerful up and to the right, low volatility kind of trading.
The stock was just back at 145.
Yeah.
So in the momentum pullback and as tech had just started to reawaken, And now these stocks are selling off a bit, almost across the board. You can go down all of the Mag 7 names are certainly down today, and the only one that's positive on the week is Microsoft, and that's by this much.
And Mag 7 has been slowly losing momentum, really, to start the year. You've seen it trade now below its 50-day moving average. Its relative performance is waning. Tech has not been a leader effectively since last summer. So you've seen a lot of divergence within tech, big winners, big losers. But the point is, tech isn't that super dominant leadership that it once was. And I think that starts to raise a question of who will take the lead from here, and is it as sustainable? It was financials. Those became momentum stocks. That's really being put to the test over the last couple of days to see if it can be sustained.
All right. Cameron, thank you. Malcolm, thank you as well. I still have some business to take care of with Steph. We need to talk United Healthcare, but we'll talk to you all soon. I know we will. All right, talk to me about this, right? You have the story today. One of the reasons why the Dow looks as bad as it does today is because this is the biggest drag. Obviously, given this report of a probe into some of the company's practices. You've been a big defender of the name. You've been a buyer on weakness. Now what?
And if I could buy it today, if I wasn't restricted, I would be buying it.
You buy more.
I would absolutely buy more, and it should never have been down 12%. It should not be down 7%. This kind of issue, coding in general for Medicare Advantage, has been around forever. And we still haven't gotten answers from last year's DOJ probe. And we don't even know if this is new or not. We don't know if this is past prior issues, or is it going to be for going forward? I think it's past, because they have changed the rules on coding, and they're phasing in stricter methods for coding. It's called V28. It's very technical, but from between now and 2026. So you're not going to have these issues going forward. That's number one. Number two, it's a civil issue, not a criminal. So I think there's likely it would be a monetary settlement. They've got $20 billion of cash in free cash flow. They've got 0.5 times debt to equity in terms of on their balance sheet. So they've got no debt. And the stock is trading now at 15 times forward estimates, and its historical average is 22 times. It's trading at 6 times EBITDA for the #1 managed care company in the world. So to me, I think it's an opportunity. I think this is noise. It's not that it's not going to go away. It's going to hang around for a while. It's not going to go away so quickly, but I do think eventually we will get through it, and they will be able to grow earnings 13 to 16%, which is their long-term algorithm.
Bill Ackman posts earlier today on X, quote, "My psychological short here is paying off, and I would avoid this stock. When you find 2 cockroaches, it is almost a certainty that there will be many more. And a $500 billion market cap for a health insurer makes no sense."
Well, if you're growing 13 to 16% on a compounded annual basis, and you have some blips along the way, but you're growing that kind of earnings, and you have a franchise like you do, and you have products and services and margins that are going to improve, I mean, I think you do want to take a look at something like this that's down substantially, and it has lagged the past year too, right? It's not even lagging just this year. It's lagged all of last year, because you do have these headlines, and they're not positive. Don't get me wrong, but I just think that they're manageable, and the company continues to generate good earnings. And the margin story. I mean, you had historically high utilization rates last year. You had lots of competition last year. That actually starts to abate this year.
Yeah, but I mean, you don't think that the game's changed a little bit around this stock?
I do not.
Like, everybody knows what I'm alluding to.
We went through this in 2017. Same thing, all right? I mean, every so often, the DOJ will look into this business, these practices, and there are some issues with regards to coding. But that's why I say
I'm not talking about the coding. I'm talking about the coverage. There are people who won't buy this stock now. This has now been put into a group that some people think is a no-touch, that is going to be under a lot more scrutiny, whether it's by the DOJ or by investors themselves.
They have been under a lot of scrutiny over the last several years, after the last couple of decades, to be honest with you. But I think that this is a company that has been able to deliver on earnings no matter what kind of issues that they're facing in terms of legal DOJ lawsuits and that kind of thing. So to me, I think this is an opportunity. Sure, it may not be for everyone, but it's certainly up my alley, because I like blue chip quality on sale, and that's what we're getting here. It may not get resolved near term. It may not even go up near term. But I think between now and the end of this year, it will.
They called the Wall Street Journal's reporting, quote, misinformation. No. They said, quote, "Any suggestion," this is the United Health Group responding, "any suggestion that our practices are fraudulent is outrageous." and false, just to reiterate what that company has said in response to that report. Steph, thanks.
Thank you.
All right, Stephanie Link here with us at Post 9. So Mackenzie Sagalis now for a look at the fintech space. What are you watching?
Hey, Scott. Coinbase shares are down more than 7.5% and trading at session lows, despite the SEC officially dropping its enforcement case against the exchange after nearly 2 years. Now, CEO Brian Armstrong called the case bogus and said that it marks a huge day for the crypto industry, hoping that it sparks a domino effect for others facing regulatory scrutiny. Notably, Coinbase will not pay any fine and does not have to make any changes to its operations. But despite that legal victory, both the crypto market and fintech stocks are tumbling alongside the NASDAQ as high volatility names get hit hardest. Now, the Finks ETF is down 4%, with Robinhood, Affirm, and PayPal all in the red. Block is the biggest laggard, sinking 18% after missing Q4 estimates and disappointing on 2025 guidance. Now, investors are concerned about flat Cash App user growth and weaker than expected momentum in Square's seller business. The company is also losing market share to Toast, Clover, and Shift4, which continue gaining traction in the SMB payment space. Now, while Block shares had been climbing over the past year, today's sharp decline erases most of those gains, Scott, suggesting that investors are growing increasingly impatient with the company's execution.
Mackenzie, thank you for that report. Mackenzie Sagalis. To Seema Modi now for a look at the biggest moves in the tech space this week. There are many, including a lot of red on that board today, Seema.
Scott, let's break it down together. The tech trade has had its challenges this week. Momentum fading in names like AppLovin, Cadence Design, and Palantir following some insider stock selling and news that the Department of Defense is looking to cut its budget. That name specifically, Palantir, down about 14% this week. And we will hear from CEO Alex Karp, who was speaking at the New York Economic Club on Monday. Some of the other big losers in tech, CrowdStrike, ARM Holdings, and Trade Desk, all down around 10% for the week after today's sell-off. Software stocks as a whole are down on average by 2 to 3% this week as investors count down to Salesforce earnings. CEO Mark Benioff expected to provide an update on just how much money Agentforce is bringing in. That CRM report comes in on Wednesday. Intel actually a winner for the week, Scott, on a report that it may split, may partner with TSMC and Broadcom, so shares are outperforming this week. Elsewhere, big tech, just the larger cap names did hold up better than the pack. Apple mostly flat for the week, and in focus today after removing its advanced data protection feature in the UK. Names like Nvidia keeping weekly losses to a minimum around 2.5% ahead of earnings Wednesday. Investors will be looking to CEO Jensen Huang for commentary on the supply of its latest chip, the impact of tariffs, and of course any fallout from last month's DeepSeek news. Hard to believe it was a month ago, Scott.
Yeah, I know it. Perfect setup for us. Seema, thanks so much. Seema Modi. Staying with NVIDIA now, earnings obviously front and center next week. The latest checkup on the strength of the AI trade. For more on what to expect and what the current landscape actually looks like right now, let's bring in First Mark Capital founder and partner Rick Heitzman. Welcome back.
Hey,
it's good to see you. So let's just think about NVIDIA for a minute. I mean, in general, what do you think is on the line next week for the AI trade?
Well, it's really, are people continuing to spend on CapEx? And we're seeing not only the hyperscalers, but also companies in the private market continuing to bet big on the long term on AI and therefore continue to buy chips from NVIDIA.
So we heard within the last 24 hours from Jensen Huang, CEO, who addressed the fallout from DeepSeek, suggesting that the market got it wrong, that all it shows you is that you're going to need way more compute, not less. Some of the other hyperscaler CEOs spoke of, similar needs following that really big upset that we witnessed in the market, and I'm sure you watched it as closely as everybody else. Is that how you see it too?
I don't see it exactly the same way.
Where's the nuance then?
I see that there are going to be open source and closed source data sets, and they're going to need different amounts of compute to be able to work together. But, all the big models are going to need a massive amount of compute. So maybe the hyperscalers will have some closed models, even OpenAI having closed models. But some of the open source models will be used by more of the startup ecosystem and people who need to be more capital efficient.
Did you come away from that story thinking that it was less bullish for an NVIDIA, or at least even to some incremental degree? Did you come away thinking that?
A little bit, but not really, because what you're seeing is that there's still this fundamental demand from AI. The important thing is DeepSeek immediately rocketed to #1 on the App Store, which means there's still fundamental consumer demand for whatever AI products out there. And as much as you could track, fundamental demand equals demand for NVIDIA chips, and therefore that demand will remain for the near term.
You mentioned the amount of money that the hyperscalers are spending. I mean, it's extraordinary,
yes.
Right? How long does the market accept that?
They have to accept it for the rest of 25, both on an offensive and defensive perspective. No one's going to announce on their earnings, oh, we're going to spend less because we believe less in AI. That's not going to be a 25 story. It's, hey, we have to be offensive and defensive. We're at least halfway across this lake. We're beginning to see with things like Agentforce, the AI is working, it's driving ROI, and we need to continue to double down on this hand.
As a VC who's backed some what are now really big companies that were once just startups, did you come away at least from the DeepSeek story thinking in any way you're now going to be able to do a whole lot more with a whole lot less?
Yep.
I'm talking about money and how that impacts the kind of companies you want to invest in and the dollars you want to put.
I think it was exciting from that perspective that there's more open source models. You'll be able to do them in different ways, and they'll be much more, to your point, capital efficient than what we would have guessed 6 months ago. So you're not going to need. I came away less bullish on OpenAI. I did. It was closed models who are claiming you have to spend tens of billions of dollars to have these models work. And what DeepSeek proved, and they spent more money than they probably would have let on, is that if you have an open source model and you have a data set, you could build smaller applications much more cheaply, which is awesome for the startup.
So then you were theoretically more bullish on Meta.
More bullish on Meta.
Well, because Meta that day, if you recall, was the only stock in the group that was up. And it just finished this week a 20-day win streak.
Yeah, and because they're open sourced, they want people to build on top of them. They want to be part of that model ecosystem as opposed to being closed and having everybody just work within their parameters. So open in the long term generally wins. And therefore, it's benefiting Meta in the short and medium term.
Probably the biggest theme of this week is uncertainty, right? Cool. I mean, everybody's thinking about it. I'm sure you are. Companies that want to go public are. Where are the IPOs and when are they coming?
It's going to be longer than we would have guessed. I would have thought they would be starting to come in a month or two. I think uncertainty is the worst thing for IPOs. Uncertainty on inflation, which affects interest rates, uncertainty of what are the rules of the road and where are we going, and just general lack of confidence in the investor marketplace. In January, IPO anticipation was at a 3-year high. If you look at the Jefferies report, the buyers had more buying demand than what you'd have guessed in years, the highest they ever had. That's my guess is, although the next quarter is not out, that's waned significantly, both in terms of inflation concerns as well as just overall market volatility.
I mean, speaking of January, you had the slowest January for deal making in decades.
Yes.
I mean, again, not exactly expected by many how this year was going to start. Now you got news this week of fewer deals, perhaps, because the Biden era regulations are staying in place. Number one, were you surprised by that?
I was surprised by that, but when you talk to the banks, they see a huge M&A backlog. Even some of those regulations staying in place, it's still going to be a loosening. If you talk to the hyperscalers or corporate development groups, are busier than they've been in years. We've had 8 exits in the last 2 quarters at very good multiples. So we're starting to see those corporate development groups, either in vertical software players that we announced, a company called CCC, bought a company called Evolution IQ, or CyberArk buying Zilla, shows that people are back in business when they were sitting on their hands.
What I'm thinking of is you're talking about those companies. For many, they're going to say, well, sure, those are smaller, more middle market companies than very big firms that are going to try and do deals that thought maybe they could, and now they're rethinking that.
They're not rethinking it yet. I think they're waiting to see how this plays out, and I think you're going to see more public-to-public deals. You're going to see more large-scale private deals, and the pullback in the IPO market might open up a little bit in the M&A market for folks who want liquidity.
All right, appreciate you, man. Thanks
Thank
for being
you.
here. That's Rick Heitzman, First Mark. Once again here at Post 9, shares of Hims and Hers are sinking in today's session. Brandon Gomez is here with what is behind that move. Brandon?
Hey, Scott. Yeah, Hims, which offers compounded Wegovy and Ozempic, plunged after the FDA announced the shortage of those drugs is now resolved. Remember, Hims sells those cheaper versions of GLP-1 drugs by combining ingredients to customize treatments, but we're only allowed to do that during this shortage. So now the FDA's guidelines do have an off-ramp for Hims. It says they have until May 22nd to compound, distribute, or dispense their product. The company's CEO, though, saying this isn't the end of the road. Posting on X, we will continue to offer access to personalized treatments as allowed by law to meet patient needs. Well, what does that mean? What it could mean is that legally the FDA permits compounding to keep taking place if it addresses a patient's clinical needs, regardless of a shortage. Just need a prescription, and the drug has to have some fundamental difference in terms of its formula, something for investors to listen to on Monday's earnings call when the company reports. But Scott, I'd anticipate some back and forth in terms of the legal ramifications of compounding here.
All right, good to know. Big mover today. Brandon, thank you. Brandon Gomez. Back to Seema now for a look at some of the other stocks that she is watching. Tell us.
We are combing through this market real time here, Scott. Shares of Akamai tumbling after posting first quarter guidance that was weaker than expected. It also revealed that TikTok is a bigger customer than Wall Street had realized. The cloud computing company getting hit by several downgrades today, including Bank of America, Piper Sandler. Analysts at B of A specifically writing that they see limited near-term catalysts as the company undergoes sort of this year of transition, but they remain positive on the long-term story. Stock is still down about 20%, trading at its lowest level since May of 2023. Celsius is surging after the energy drink stock reported record full-year revenue, fourth quarter earnings that topped estimates. The company also announced it will acquire rival Alani Nutrition. Shares of Celsius you'll see up about 27%, pretty commendable given the down day today, Scott.
All right, Seema, thanks so much for that. Seema Modi once again for us. Joining me now, Ed Yardeni of Yardeni Research. Good to have you on this, unsettled end of the week, I think we can say. What's your opinion of it?
Well, yesterday it was largely because of Walmart's guidance that kind of spooked everybody about the outlook for the consumers. Today we've got the United Health issue. And so I think you got a couple of very expensive stocks that are taking a little bit of a re-rating here. I mean, that's what Walmart's doing. And they have a forward PE of 38. I think the consumer's still okay. I'm looking at weekly data like initial unemployment claims, and it looks like the jobs are still there, even with what's all the craziness going on in Washington. And I'm also looking at the weekly retail sales series, and that's up like 5% on a year-over-year basis. So I'm not particularly concerned that we're suddenly looking at a correction or a bear market. Bear markets are caused by recessions. I don't see a recession, and corrections are caused by fears of a recession, and maybe the tariff thing is doing it, but I don't think so.
Some look at the divergence between discretionary and staples. I don't know if we can throw, a chart up that shows what I'm talking about specifically, but the trend has not been great in terms of discretionary is the worst. There we go. Thank you. The discretionary is the worst of this year, and there's been a lot of money going into staples. Concerning to some, not you?
Well, I think it's a short-term issue here in terms of the fundamentals. The fundamentals still look pretty good across the board for consumer spending. Yeah, they're spending on consumer staples, but I've noticed that even with a weakness in home sales, furniture sales have really been very strong over the past several months. Car sales have been volatile, but they were very strong at the end of last year. A lot of discounting, so there was some weakness in January. Consumers are definitely spending on durable goods now, and that was something that they stopped doing for a while after they went on a buying binge following the pandemic. So from a fundamental perspective, I'm not particularly worried.
I mean, I played earlier a soundbite from the billionaire investor owner of the New York Mets, Steve Cohen, who's down in Miami, who talked about how he's feeling less confident about the economy for a variety of reasons that are on the mind of a lot of investors, including the likes of Citadel's Ken Griffin, who talked about tariffs, our alliances globally, and just the uncertainty that it has caused in their minds, perhaps unnecessarily. And I'm wondering how you think the average investor should think about that?
Well, life doesn't come with any guarantees, and there's always uncertainty. And I think now with this regime change between Biden and Trump, we certainly have uncertainty. But that seems to be the nature of our political cycle. We go from, one president to the next, and before you know it, we have a radical change in policy making. And I think it takes a while for all this to settle down. But certainly there's concerns about tariffs. There's concerns about getting a budget together. And then, of course, the whole geopolitical situation looks pretty messy right now, clearly. But at the end of the day, the stock market is driven by earnings and valuation. Valuations are stretched, so we're seeing some re-rating to the downside. Even the Magnificent Seven have at least stopped going up on a valuation basis. But the earnings picture still looks really bright to me. And I think that the AI, robotics, humanoid, technology-led productivity boom is still very much with us. And I think we're going to continue to see that in better than expected profit margins and better than expected earnings. I think earnings are going to drive this market for the rest of the decade.
Well, I mean, they've certainly surprised many how earnings season performed. Mike Santoli, our senior markets commentator, is at the desk with me, Ed, as well. I wanted to bring him into the conversation. I mean, you came into the year, Mike, thinking, I remember back when I'm sitting in Beverly Hills with Todd Bowley, and he mentioned animal spirits.
Yeah.
Just this idea that there was so much pent-up demand to do deals and to have a better and more loving embrace of business, if you will, taxes, deregulation, Fed cuts, so many more things that now we're questioning all of a sudden. We're only 30 days into the new administration.
Yeah, we're questioning certainly the sequencing of things and the fact that pretty much the storm of proposals and efforts that are out there now on a policy front are mostly, if they affect growth at all, they're growth negative or they add friction to the system. Been saying that for a while. I do think, though, that everyone recognized we weren't going to see a massive boom in the first quarter in massive IPOs and huge M&A deals. It was going to be something that could build along the way. What I did probably expect is that you had a starting point, very strong economy. Earnings are doing their part. That's really not the thing to be concerned about. Revisions are not great, but they're fine. I really do see this sort of cumulative evidence of just a stutter step in growth, consumer fatigue, all the things you're talking about, the January retail sales, the Walmart numbers, today's services, ISM services shortfall or PMIs, just enough to exacerbate this idea that we're not accelerating. Now, market action itself is down to the 50-day average. We were here earlier this month. It's not really shaking the trend, but it's very listless. We've been talking so much in recent days about this magical rotation that's keeping the indexes out of trouble. And you had the gears are grinding on that rotation here a little bit. In part, it's because the defensive parts of this market can't carry the load all the way, especially when UNH can't help healthcare do it. The pharma stocks are all up. And so I think it's looking like it's a little worse than it might otherwise because of all that. But yeah, an expensive market with high expectations has to reckon with these things.
Speaking of, Ed, I don't know that there's a stock in the market that has higher expectations than NVIDIA, which always does, and it's going to again next week, and maybe the stakes are higher given the way we're ending this one.
Well, that's true. They are higher, and everybody will be looking at NVIDIA as sort of the harbinger of where AI is going. But we'll see. Elon Musk just spent quite a bit of money on thousands of NVIDIA chips that he put together, and within a few weeks or maybe months, they put together a large language model, which is very competitive with the other ones. I think the fact that we've got everybody scrambling to build the next best large language model, and every week we seem to have another one, I think that's great progress in terms of what the users of this technology are going to be able to do with it. I think that's already happening. So yeah, I think NVIDIA is very important. But so are 493 other stocks besides the Magnificent Seven, and I think they're going to continue to crank out better and better earnings.
Well, that's the big question. If we're going to now start worrying about growth, maybe that broadening trade to the 493 comes into question, no? Well,
look, it's only been a couple of days here that the market's got a pullback. I think, I I always like when Mike calls them pullbacks rather than corrections and bear markets. I think it's a pullback. A pullback occurs every now and then. It's a natural development. It's only a couple of days. I mean, we were at a record high not only a couple of days ago. So all in all, I think it's premature to conclude that the economy is slowing down. I think the consumer is going to continue. I think the retail sales number in January was, when in doubt, blame the weather.
Blame the weather,
a lot of it was weather related. I think it's going to bounce back sharply in February, and then with the S&P Global Services Index, pay no attention to data that doesn't support my story. I'm not a big fan of that particular series, quite honestly. And at the end of the day, it's going to be the official NMPMI, the non-manufacturing PMI, that will drive things. And I can't imagine that services are slowing down the way the S&P Global Index is indicating.
Yeah.
I mean, I was just going to say, if you think that this economy is pretty much on cruise control and we're not seeing any bit of a slowdown, it's giving you an opportunity. Industrials, small caps, and banks are all trading back into the November 6th gap. That was the big surge in cyclicals and Trump trade that happened the day after the election was decided. So, I mean, the market's expressing some reservations and a little bit of a reset of cyclical expectations.
Look at the transports.
Yeah, exactly. So that's one of the weaker parts of industrials. Of course, you're also losing the defense stocks.
Yes, you are.
So here's the thing. I kind of agree that nothing radical has changed. But when the market responds in a way to these data points that could otherwise be shrugged off, it was like I said yesterday when, they're going to cut the defense budget 8%. That shouldn't affect Palantir. Well, guess what? Palantir's down 10% in 2 days because it was the time for a stock that was too stretched to sell off. Steve Cohen said almost exactly the same thing to us in late January about being concerned, and this is all growth negative, and we're probably getting close to some kind of a top. Market wasn't ready to hear it. It just didn't matter. Now the market was ready to hear it today.
Yeah. Good stuff. Mike, thank you. You'll stay for the Market Zone. Ed, thanks so much, as always, for joining us on the fly here as we're watching this close. And a bit of a nasty one, obviously, at the end of the week. That's Ed Yardeni. We are in the closing bell Market Zone now. CNBC senior markets commentator Mike Santoli is still with me, of course, along with senior markets correspondent Bob Pisani to break down the crucial moments of the trading day. Bob, what jumps out to you?
Well, what I see here is I think the problem today is that we may have an additional market risk that's emerging. So remember what we have already, that's already in the market. First, we have concerns about inflation and Fed rate cuts. And second, we have tariff risks. And then third, we have these Washington headline risks where every day some sector might get hit by some comment out of somebody in Washington. Today, though, it seems like there's an additional problem, a bit of a growth slowdown issue. You saw the yields drop this morning, 9:45, 10 o'clock in the morning. This is when we had some of the PMI numbers that came out. Then we had some of these Michigan consumer confidence numbers that looked a little weak. Existing home sales looking a little bit weak. I think there's a little bit of a growth slowdown to add to these other three issues that are going on here. And if you look today, I mean, look at the laggards today. These are all cyclicals. It's, the transports are all weak today, like Old Dominion or some of the classic big middle sector industrial names like United Rentals, and material names like Freeport McMoran are weak, and Cummins in the industrial space are all weak. And what's up today? Scott, it is a strange day when the upside leaders, every single one of them, are defensive names. When Hershey is your upside leader in the S&P 500, that tells you something right there. This market is very defensive right now. So that's the bad news. The good news is on the volumes, I don't see huge selling going on here. A little above normal, but not a lot. The VIX at 18, not a big worry. Earnings, I agree with that. It's still good, but coming down here. So today's a bit of an air pocket, let's call it, and let's watch that growth concerns that I think are popping up right now.
It is why, Mike, some still say, and I think the majority of people still feel good about where this market is.
Sure.
And it's dangerous to get too negative, knowing that you do have what is perceived to be a pro-growth administration.
Sure.
You think you're going to get tax cuts in some form. you're going to get deregulation in some form, and you may get tariffs in some form too. And you'll have to weigh one versus the other or two versus one.
I think you're definitely getting deregulation. It's already in train. Whether you're getting tax cuts or you're just getting the extension of the current tax code, we'll see. Maybe there'll be marginal cuts on that front as well. I do agree that you can't get into too much trouble if things stay at, 2% real GDP, 2.5% inflation, 4+% unemployment rate. I mean, these things are fine. The yields are also, at some point maybe take some pressure off, even though right now they're expressing growth scare. 10 years down on the year in yield. So I think that's true. One of the issues, though, is just exactly what the process of bringing expectations back in line looks like. So we've had this rolling sort of corrections or resets of psychology. Housing has obviously been stuck for a really long time. It's not a help. Employment has been okay, but in this fragile equilibrium with not that many openings. So I do think that you might have to work through a little bit. The other part of it, though, is, of course, it's happening right on time when we all know seasonals get a little bit tougher. I've been talking about the expirations and how that today is one of them, and afterwards sometimes the market can get a little more squirrely. Maybe this is all of it. It would be kind of too cute to say it's going to happen on the day and that's the top. The other piece of it, I know you were talking earlier about this report about the new form of COVID or whatever it is in this research that's been out a couple of days.
Yeah, a couple of days.
I am 100% convinced the reason, if that's having any effect on the market, it's because we're 2 days past the 5th anniversary, and the takeaway from everybody on Wall Street of the 5th anniversary of the peak in the stocks before the COVID lockdown was, wow, the market really didn't see it coming, did it? We didn't price anything in until we absolutely had to. And so to me, I think that's another thing. If that's what this is about, it's probably fleeting.
Let me ask you another thing, because Berkshire Hathaway so very well.
Yeah.
And you always make the pilgrimage with all those people who go out to the annual. They report their earnings tomorrow.
Yeah.
And you have a lot of people wondering what is going on with that mountain of cash. They continue to lighten up on their positions. And is it they see something we don't? The same questions we've been asking quarter after quarter after quarter, because the cash pile has gotten larger and larger and larger.
Yeah, it's growing passively is the way I would think about it. I think there's a lot of portfolio manicuring going on. Clearly wants to kind of get the financials holdings back below certain thresholds, get Bank of America stake below 10%. Apple got quite expensive relative to where he bought it. He sold a bunch of it, not much more recently. Berkshire's been kind of on hold with Apple. That said, they clearly don't see enough big, full companies to buy at a proper price.
Not a great price.
That's it. I mean, and that's the only thing that you can say is they're not making a macro call explicitly, but implicitly, which we know. We know the market's kind of fully or richly valued on most fronts. I also do believe that given at some point in the not too distant future, there's going to be a CEO transition here, that maybe Warren Buffett is interested in preserving so much flexibility in terms of how the company is positioned with the cash and not making any huge additional bets in the short term, just to give maximum flexibility for the new regime. So all that's, I think, at work. It's obviously, kind of confounding. I know for a fact they love getting paid on what cash is paying right now and all the dividends on the stocks that they hold. 20% of every dollar of dividends American Express pays goes to Berkshire Hathaway. And so I feel as if it's not so much a sell signal as it is, if you're buying today not because stuff is cheap, but because you think the economy's okay.
Yeah, it's just interesting. It's the danger of speculating, but how can you not speculate when it's Warren Buffett and Berkshire Hathaway? Bob, the other thing that jumps out to me today, and certainly this week, is the activity in China tech. Alibaba, PDD, JD. You could throw some other names in that basket, too. Just as the conversation about investing outside the United States is really percolated.
Yeah. This is a very interesting moment to get mean reversion. And a lot of people, we had a big debate about this earlier in the week on ETF Edge. Why is Europe suddenly outperforming? Why is China, and particularly China tech, outperforming? But even some emerging markets like Poland are outperforming at this point. And the early speculation has been that this push for global deregulation would make some kind of difference. We also saw Xi Jinping the head of China, meeting with people like Jack Ma this week. That to a lot of people was a sign that perhaps he's gone too far in the other direction, is now having to court these people that he previously had shunned. So I think a little bit of hopes for better global growth on some deregulation, as well as maybe a little bit of a pivot on China. It's about time, Scott, you know as well as I do, that global investing has underperformed the U.S. for 15 years now. And
Bell's going to ring in a moment.
reversion is
Obviously,
long
we're going to be
overdue.
red. Perspective, though, we did hit new closing high on the S&P this week.
Closing exactly the 50-day average. It's kind of cute, yeah.
All right, great having you here, Mike. Thank you, and thank you to Bob as well. We'll send it to overtime for more of a wrap-up on what this week has delivered with Morgan and John.
That bell marks the end of regulation for the week. Jericho Project ringing the closing bell at the New York Stock Exchange. GSR3 Acquisition Corp doing the honors at the NASDAQ. And speaking of Jericho, stocks falling hard to end this shortened trading week as UNH drags down the Dow, tech tumbles, small cap sell-off, and soft data spooks investors. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
We'll be all over the sell-off throughout the hour. FundStrat's Tom Lee will tell us why he sees a contrarian bullish indicator in this pullback.
Plus, noted housing analyst Ivy Zellman is going to break down the rough stretch for the home builders after more downbeat data on home sales today.
And Goldman Sachs tech analyst Eric Sheridan will join us with his take on the dip for the technology stocks ahead of more earnings from the sector next week, including from NVIDIA.
Well, let's sort through the wreckage with the sell-off with Unlimited CEO Bob Elliott and Truist Wealth co-CIO Keith Lerner. Happy Friday, guys. Keith, we were at these levels. We're at what? And around, let's see, over 6,000 still on the S&P. Late January, late December, late November. I mean, so in a way, we're not, it's a bad day for the market, but not out of a range. You seem to be saying there's no reason to believe that stocks are falling out of bed here.
Well, first, great to be with you, even though it's an ugly day. I think the big picture is right. This market has been churning. It's been a split market below the surface. Our overall theme for this year was a bull in a China shop. We think the primary market trend is up, but we thought there would be some disruptions. And if you go back to November, initially the market was focused on all the potential positives as far as deregulation and taxes. And back then we said, you know, coming into this year, we think the market would start to focus on some of the other side, such as tariffs. And I think in the short term, the market's a little bit heavy here. There is that kind of a little bit of a growth scare with some of the PMI services numbers this morning, the Walmart numbers, consumer sentiment. So I think we are going to be in a choppy period. And don't forget, in March, we're going to start getting some of this event risk around tariffs and the debt ceiling battle. So all in all, I think we likely have a little bit more downside here, but that's in the context of a bull market, in our view, that's still intact.
Okay. Bob, Friday Bob, always good to have you here on set, especially on a Friday. Growth scare in a couple ways. Growth stocks took it on the chin, particularly today. A lot of the larger tech names weren't hit as bad, but it was NVIDIA, Tesla that were kind of growthy. But you think there's also a global growth challenge here?
Well, I think what we're basically seeing is the market's starting to recognize that the euphoric expectations that were built into the prices that we're seeing may not come to fruition. And all this belief of this being the most pro-business administration that has existed in the post-war period is starting to be questioned. Why? For good reason. If you look at the actual policies that are being pursued, the priority is tariffs, decreasing immigration, and cutting spending. And all three of those things will lead to hits to nominal GDP. And if there's one thing that stocks don't like, it's hits to nominal GDP. And so we're just starting to see some signs in the data, but the big tightening effect is ahead.
So in light of that, I mean, we saw a very defensive tone to the market, Bob. You've got, I'm looking at a 10-year Treasury yield at 4.429%. You actually saw consumer staples finish higher in the S&P today, and utilities basically flat, again, speaking to this defensive tone in the market. Is this the right way to be approaching positioning right now, given the fact that there is this growth scare shakeout happening, or is it overdone?
Well, I think the big question in the market is where is the mispricing in terms of the expectations? And if you look at something like the Mag 7, they have relatively high earnings expectations, but they're actually expected to slow their earnings over the course of the next couple of years. It's really a story outside the Mag 7 where you see earnings expectations are pricing in an acceleration. So hopes that either AI is going to deliver incredible benefits or that the U.S. economy is going to power forward in this pro-growth administration. And I think there's a lot of questions about whether that's really going to come to fruition. One of the most interesting things is we're starting to see those 25 year-end earnings just in the last couple of weeks start to come down in terms of the expectations. So it's possible we're seeing a turn in that sentiment in the market.
Keith, I want to get your thoughts on this, because are there buying opportunities when you see major averages down as much as they were today? I'm looking at the screen right now. We basically closed at session lows. S&P down 1.7%, Dow down 1.7%, but the Nasdaq down more than 2%. Russell 2000 down almost 3% here to finish the week. We're talking about the growth scare. You also had soft economic data this morning, most notably the Michigan sentiment numbers, options expiry, and as Mike Santoli has pointed out, this 5-year anniversary of the market peak pre-COVID, just the fact that we're lapping 5 years in a couple of weeks here on COVID. What are you watching as you do have this wall of worry now for investors?
Yeah, well, I think it's a little bit premature to say there's a lot of great buying opportunities. If you remember, we just hit an all-time high on Wednesday. And when you look below the surface, small caps actually now about 9% below where they were right after the election, making fresh relative lows. We still like technology long term, but I think that kind of corrective period likely has further to go. And as I mentioned, you have a lot of event risk heading into next month. So I think the market likely will present a better buying opportunity, a bit lower from where we are today, that will present a better opportunity. I just think, again, 2 or 3% from an all-time highs where valuations were and kind of where sentiment got a bit complacent. I think we're just a little bit early to say that. But you have to also remember this market is often 2 steps forward, 1 step back. And I think we're kind of in that 1 step back period right now. That's probably somewhat early in that step back.
Oh, okay. Keith, Bob, thank you. Putting it into context for us. Well, let's turn now to consumer discretionary, the worst performing sector today, with outsized drops for travel names amid reports about a new coronavirus discovery in China. Contessa Brewer has more on those moves. Contessa?
Yeah, John, and here Macau has not even fully recovered from the downturn that came with the discovery of COVID-19. MGM getting hit the hardest of the casino stocks with Macau exposure. You're seeing it down now 6%. Wynn, Las Vegas, Sands, Melco, all getting pinched as well. The risk-off environment is really taking a toll on other gambling stocks as well. They're plummeting. DraftKings off 7%. RSA, that's Rush Street Interactive, it was down 7% to 11% today. It's been on a tear over the last 12 months. We're looking at Caesars down 6%, Flutter off by 5%. So getting hit hard. And then the cruise stocks continue sinking as well. They got slammed yesterday after comments by Commerce Secretary Howard Lutnick talking about raising the taxes on them under the Trump administration. Norwegian now off 6%, Carnival, Royal Caribbean feeling the heat as well. Global hotel brands, Marriott, Hilton, Hyatt, and Wyndham Hotel all off roughly 3%. Morgan?
All right, Contessa Brewer, thank you. In what is down day for markets broadly, Dow transports were also hit especially hard today, falling 2.6%. The transportation average now more than 10% below its 52-week high, led lower by airlines, including Alaska, United, and Delta, but also FedEx, trucking firm Old Dominion, and car rental firm Avis. Now, transports were the big underperformers really all day after a weaker economic data this morning. Reports that the Trump administration may be looking to change the governance process at the U.S. Postal Service, and also amid rumors that Amazon is preparing to expand operations as a for-hire LTL, or less than truckload carrier, as it pushes further into freight services. Now, for the passenger airlines and car rental companies, similar to what Contessa just talked about, fears of this other coronavirus in China adding pressure as the sell-off in those names really accelerated through the afternoon. Overblown? Maybe. But on the freight side, transportation carriers have been navigating tepid pricing, particularly in trucking amid a freight recession. You also got cautious commentary this week from TFI International's CEO that reinforced that. And on the consumer side, those passenger airlines, they've soared dramatically over the past 6 months. So perhaps some profit taking there as well.
All right. Well, now let's bring in senior markets commentator Mike Santoli for more on the sell-off. Mike?
Yeah, John, so this turn toward defense has been going on sort of subtly below the surface, and now it's sort of popped out into the open. This is a little bit of a tortoise versus the hare race. This is the minimum volatility stocks within the S&P 500, the U.S. Minimum Vol ETF, which is obviously, as you would expect, a lot of those defensive non-cyclical type companies. This is the highest beta stocks in the ETF. That's the fastest moving, often most aggressive, fastest growing ones. And you see here, on a one-year basis even, you see Min-Vol is now ahead of high beta at this point. It's interesting, even though Walmart is the largest holding in the minimum vol portfolio and has been pulling back the last couple of days, you've still got this advantage. So it's not going to outperform in a very exuberant tape where there's a lot of excitement about the improving fundamentals. But for now, it's doing its job and providing a little more sort of capital protection. Take a look here at industrials relative to the S&P 500. In fact, transports are part of the industrials, probably the weakest part at this point. And you see that it's kind of traveling along with the S&P 500 as a sort of bellwether of cyclical expectations for a while on the upside, and has come back down. And I think it's kind of important to note that you're now basically at levels that are equivalent to approximately election day levels. So all of those trades that were about an accelerating economy or maybe other aspects of policy that were going to help this part of the economy, they've been unwound. It doesn't mean it's over, but it does mean that there's a rethink going on, guys.
Well, Mike, with that backdrop, we've been seeing, if not a rotation away from mega caps, at least a broadening beyond them. On a day like today, with the market down, we saw some of the growthier names down more, including NVIDIA and Tesla. How important, tonally, direction-wise, do you think NVIDIA earnings are next week?
I mean, mathematically important, psychologically important. The chart looks a little bit challenged. I mean, it's really been struggling around these levels for, since last June. So it is super important in terms of whether the market reads it as, okay, we have another kind of leg to this AI expansion story before we have to worry about the build out. I feel like some of the commentary has been a little bit mixed, or at least difficult to kind of discern exactly what we should think about it. In other words, yep, everybody's reaffirming their overall spending intentions, but they're also telling you they'd be doing the same amount of spending even if they weren't sure about the payoff on the back end. So I think that whatever commentary surrounding what NVIDIA tells us next week about 2025 into 2026 demand is probably going to matter quite a bit.
We'll be watching for it, and we'll see you a little bit later this hour. Dell and Salesforce will probably also matter quite a bit next week.
Yeah.
But in the meantime, thank you, Mike Santoli. After the break, FundStrat's Tom Lee weighs in on the sell-off and breaks down the contrarian bullish signal that he sees in this market right now.
And homebuilder stocks getting rocked this week as soft housing data and Toll Brothers earnings spook investors, and the spring selling season might not bring much relief. We're going to discuss the outlook for investors with analyst Ivy Zellman. That's when Overtime's back in 2.
Welcome back. Stocks selling off today as investors grow more concerned about a slowing economy. The Dow and S&P 500 turning in their worst session of the year so far. And joining us now is Tom Lee from Fundstrat Global Advisors. He's also a CNBC contributor. And Tom, it is great to have you on a day like today where the major averages are not only lower on the day, they're lower on the week. And the Dow, the S&P, and the Nasdaq are now also lower on for the month of February so far. We teased it ahead of this conversation, the fact that you're seeing a contrarian bullish signal here. What is it?
Well, it's a couple things, but I'd say what really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher, too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they're concerned about whether or not consumers are actually raising their inflation expectations, and that would, in fact, be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So, Tom, if I recall, in Q4 last year, you were warning about market turbulence, and we've been right now at around S&P 6,000. We're at the level where we were a month ago, a month before that, a month before that in late November. Should we also expect turbulence at these levels at this point, given that the macro narrative and the political landscape is still unclear?
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. You know, we're coming off 2 back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
Okay, so tell me about these granny shots that you've got, you know, part of your investing strategy, some specific stocks, especially since growthy stocks seem to be especially vulnerable on days like today. And if we're going to get more volatility, it sounds like we might get more days like today.
Yeah, that's possible. But investors really want to own stocks that actually have structural advantages. And that's best evidenced by revenue growth, margin expansion, earnings growth, and reasonable prices. So the reason growth stocks will still outperform is that in a period like this, if we have macro uncertainty, they're going to be names with some visibility. It's not pleasant to own a growth stock today, but you know, we know the lesson of 2025 is that these pullbacks have not been deep and investors have been buying these dips. So I don't think today is any different. In fact, it's no different than the DeepSeek panic or the tariff day panic or the CPI panic. So I think this is going to be a buying opportunity.
It's interesting because Coinbase ended up finishing the day down more than 8%, but it started the day higher after it announced that the SEC said it was going to, throw out its suit against Coinbase. You've talked about Bitcoin. You've been bullish on Bitcoin in the past. Just want to get your thoughts on whether it is BTC or other cryptos right now with this new administration coming in and some of these policy changes and legal changes starting to take shape.
Well, Bitcoin overall, I think, has made a lot of progress, especially as someone looks back at where it was a year ago. And, I think Coinbase might have been selling off just, it's one of those sell the news events. But we know that the outlook for crypto actually is really favorable. Bitcoin is still very sensitive to the number of wallets and the number of activity levels per wallet. That's set to grow if the U.S. indeed really formalizes an approach to having Bitcoin as a strategic reserve. On top of that, we have a positive cycle underway with the halving. So I think Bitcoin is still set to be one of the best performing asset classes this year.
All right. Tom Lee, thank you. Have a good weekend. After the break, home builder analyst Ivy Zellman joins us to break down the big pullback for housing stocks and tell us if she sees any relief in sight.
And later, is this the entry point you've been waiting for in mega cap tech? Well, Goldman Sachs analyst Eric Sheridan will tell us the names he likes the most on these dips. We've got much more ahead on Overtime.